Hello, and welcome to Research Chatter, a podcast sponsored by the Strategic Management Society. I'm your co-host, Ronnie Chatterji from Duke University, and I'm here with Charlie Williams from Bocconi in Milan. And for the first time in 3 episodes, we are together in the same studio in Denver. Charlie, great to be here, looking across the table at you. The first 2 podcasts we did remotely.
I know. It's so different. It's back like when we were working together and we could actually just meet in the halls and talk about stuff.
These are the chats around the proverbial water cooler that we always had, and that's really the inspiration for this podcast. A lot of big ideas and also some small ideas and not good ideas. Let's be honest. They are generated around the water cooler, and we want to try to find a way to translate those ideas, the good ones, the big ones, to a larger audience, and that's what we're trying to do today with Research Chatter. Got a lot of great feedback. I think you've heard some here at the SMS.
Yeah, it's been so nice to run into people who've actually listened to the podcast who have something to say about it.
Now, I'm not sure if they're just flattering us, Charlie, but I have ran into people.
I'll take it. Keep it coming,
Yeah,
people.
exactly. Even if you are flattering us, please. But in all seriousness, we're excited to get your comments and feedback, positive and negative, constructive, all the things. We've really enjoyed doing this. And as we said at the beginning, it's an experiment, right? To try to figure out whether or not something like this would be useful for not just the academic community that we all live and breathe in, but the practitioner community that's trying to figure out how to make sense of all the stuff coming out in the journals and beyond, if they're even reading the journals, but at least the translational stuff. So Charlie, we've had a really easy time the first 2 episodes picking our topics, accelerators and management practices, something both you and I care a lot about. This one, I wasn't sold on the one that you proposed, and we had a very...
you were really skeptical, weren't you?
Yeah, I was skeptical. I think that I kept thinking, let's do something big. Let's have a big picture umbrella topic that we can do lots of things on. But you were pretty persistent on thinking that...
Well, so I'm just going to hop in because, on the other hand, I had some misimpressions about corporate venture capital. Talking to kind of people in entrepreneurial investment, I'd heard, it's so big. It's bigger, in fact, than what VCs are investing. But it turns out that's not really the case.
Yes, CVC, corporate venture capital, usually about 1 out of 5, 1 out of 6 deals overall in venture capital. If you think CVC is up and there's a new wave of CVC, it's usually because VC, traditional venture capital, is also up. And so sometimes we get this impression that things are increasing, but it's actually part of a larger pie. And CVC, look back at the year 2000 and you see that was a sort of giant year for CVC. We're sort of heading in that direction again, but there's some lumpiness, like this Google investment, Google Ventures in SpaceX. We're talking $700 million investment, or actually, sorry, $900 million investment that Google made.
Oh my
Charlie,
God.
this is not chump change.
Yeah.
So,
and how's that add into their information capabilities? It'd be really interesting to see where that one goes for Google.
Well, we're talking a $10 billion valuation for SpaceX. Is this $900 million going to pay off? I think that's a big question with CVC. What do you think, Charlie? There's been some studies on this. We review and we'll put them on the website. CVC, is it going to pay off? It seems like this is a specialized skill set. I'm not sure companies have it.
Yeah. Can they really play like the savvy investors? And there has been some good some careful looks at this. I think there's 2 sides to it, basically. There seems to be evidence that they overpay, that compared to professional investors, corporate companies, corporate investors working with all the constraints they have, they pay a little too much. And as you said, if you look at the charts of investing, clearly they're pro-cyclical. Things are up, they're piling in, things get tough, they're right out.
And that's what I worry about, Charlie. That's what I worry about. I sit through all these talks about should the government be a VC, and the answer is usually no. And if you just substitute government for anyone else but a VC, should anyone else be a VC? And I'm not sure.
Yeah.
Even as an asset class, VC hasn't performed that well. So why should we think?
It's true. They're not starting from a high.
That's right.
Not starting from a high bar.
Why should we think a corporation, even a Google, much less a GE or an Intel, why should they be able to compete with the Kleiner Perkins, the Sequoias, the NEAs, a really top shelf VC?
Now, there was one dimension. Gomper and Lerner's have one of the first careful analysis of these. It's getting a little old now, about 10 years ago. But they say that corporate venture capital investments compared to VC actually exit successfully. So they go to IPO most often, but also acquisition more often than equity from straight up venture capital. So in one dimension, at least, it looks like they're doing a little better.
That's right. But then, Charlie, we have the overpaying thing. You see the overpaying both in the initial investment that's documented in that paper and also on acquiring these companies. So Benson and Ziodonis have this neat paper in the JFE where they basically pitch CVC as a window into companies that can later be acquired. And that certainly does happen. But again, they find that those acquisitions destroy value. And that was pretty much a stunning result out of that JFE paper by Benson and Ziodonis.
It's huge. One off, on average, I think they said they lose about $63 million. And that's for companies that are successful acquirers. So when they haven't made a prior investment in these companies, they're having a positive return. But when they had this CVC, that one's a bit of a mystery, I think. But it's not fair to weigh all this material or all these investments only on a financial basis.
Wait, but Charlie, you want to change the goalpost? I mean, right?
I do. I mean, companies are not trying to be investors. They're not necessarily just trying to be VC. They're trying to be more like the entrepreneurial startups. They want some of that innovative magic that we talked about in the Accelerator podcast.
Oh, that's actually an interesting point. So yes, okay, maybe on the financial metrics alone, these CVC investments don't look better. Maybe they look worse. Depends on the metric you use. But you do talk to a lot of CVCs and they say, look, there's strategic rationale behind that. And at first I worried that was kind of a cop-out. Oh, so you're not making your financial return, so it's strategic.
That's so true.
But in some sense, right, there might be reasons to go after these companies, make these investments that don't have everything at least to do with financial return. You know, maybe they're trying to learn, as you said. I mean, Dushnitsky and Lennox, the 2005 research policy paper, they find that, right? They find that basically you make the CVC investment as an operating company and you see more patents and citations, right, in those directions later on, right? And they try to do this study. And so you see a lot of things about learning from the portfolio investments.
Yeah. And they look across a couple different industries and they do find this effect. The companies that are putting more dollars into CVC, they are getting more patents, more important patents out the other end. Similarly, Anuwadwa and Kota have
Suresh Kota, right?
Yep, Suresh Kota. They have a paper that looks just at the telecom industry, and they look at count of CVC deals. But again, they find that more or less there's a positive effect that companies that are doing more are seeing more patenting.
But Charlie, here's the other mystery to me. So okay, maybe it's not about finance. Maybe there's some strategic rationale. Hey, that's great for strategy scholars because it puts us in our wheelhouse. Okay.
Yes. And this is where strategy scholars are really they've come at this and made a real contribution.
That's right. That's where we're doing it. But what Gompers and learners find and what Ian McMillan, who has this really nice paper for the Commerce Department, finds, these things aren't around for very long. And my PhD student at Duke, Song Ma, who's on the finance market, he finds the same thing. I mean, 4 years or something or less. So why aren't these CVC units durable if they're providing so much strategic value? It seems like lots of them aren't making investments after a while.
Well, so I think some of the research can speak to that because there are times when it's more useful and more important. So it's not just this average effect. The effect, the positive, the learning, the innovation that comes from it happens in some cases and not others. And when companies do some things and not others. So, I mean, what was your impression about that? What we learned?
So here's the thing, right? I mean, anyone listening to this podcast who's not an academic, and hopefully you're out there, right? You can contact us.
Yes.
Okay.
Let us know.
Right, exactly. Let us know. Hey, we're also looking for funding. So look, at the end of the day, they want to know, should I set up a corporate venture capital unit?
Yeah.
And if I set up, how should I organize it? I thought that was the kind of cool thing about McMillan's work with several co-authors, and we'll post these on the website. He basically surveyed these CVCs to figure out, how are you organized? How do you think about the strategic rationale? And he found some interesting variation, right? Some of them, these CVCs report directly into the operating company, right? There's a manager that's supervising. Other ones are more autonomous, okay? And you think about organizing innovation in the firm, our MBA students will probably say, hey, keep this as far away from the company as possible, right? We don't want the bureaucracy of the big company infecting the CVC. Turns out, though, with a strategic rationale, that's not necessarily the case. You might actually want to keep it close so you don't have mission creep. So, I mean, so if you were setting up one of these, Charlie, what would you do? Would you keep it close or would you keep it far?
Well, there's some complicated, my first impulse would be tie it close because clearly the benefits are there if you're learning in some way. And the research points to a couple different things, the ways these companies are learning. If they have seats on the boards of these companies, Wadwa and Kota, they find if you have more alliances with these CVC investment companies, that you get a lot more innovative bang from them.
But Charlie, if you keep it close, and this is, our listeners who are going to ever, manage these CVC units, decide to set it up, keep it close. Are you going to be able to attract a top shelf venture capitalist to come work inside a company? Can you replicate the incentives and the compensation that you'd get working at a top VC firm if you keep it close to the company?
It's tricky. It's not clear you want to exactly. And the more your goals actually shift over, you don't want exactly the same investment scheme. But so I'm gonna mention some research that Gary Dushnitsky is doing now. He's revising the paper, so he couldn't send us yet the current copy of it. But he actually finds these sort of interaction effects, basically, that the closer you pull it, and particularly he's looking at, did you pull this down into the business unit? So your operating people, your R&D folks, they are really involved in these investments. The more you do that, the more the really good target companies shy away from you.
Sure.
They're a little nervous about that kind of involvement.
And McMillan points out in his survey that a lot of the R&D professionals are interacting with the CVC units. See, part of you would say, look, that's a great thing. We should be kind of sourcing knowledge from all around the firm, and the notion is you have absorptive capacity, right? You'd be able to leverage some of that. But that also may make you biased towards things that the firm is already doing. And maybe CVC, right, and thinking of a diversification strategy should get you invested in things that are very different, right? Yeah. So when your business is down, that business and those CVC investments will be up. So, I think the first piece of advice I give to someone who's setting up a CVC unit and running it would be, why are you doing it? Are you doing it so you can generate financial returns? Well, then it's going to be very difficult to do that inside an operating company. For strategic rationale, are you doing that to sort of reinforce your existing capabilities, or are you trying to add new ones? And that might portend where I would put the CVC unit. Yeah, so I think that's like a key. And look, sometimes I think we run these horse races between things that are just different. I mean, comparing CVC to VC on financial returns.
Actually, so just on the separate unit thing, I just wanted to point towards the Benson and Zedonis paper you mentioned on the acquisitions. They actually start pushing in this. Do you have a dedicated unit? And one thing they find is the acquisitions do even worse when you have this dedicated CVC unit. So somehow that building those professional routines around doing it may be pushing the companies to escalate their commitments in a way
this is true.
That's not really helping them.
Now, Charlie, let me throw it out in a totally different direction. We've been talking about strategic rationale.
Yeah.
Maybe these investments are all about antitrust policy. Maybe it's that, look, you can't, if you're a big company, get into too many markets, right? And so maybe you make these CVC investments to get a toehold, a legal toehold, right, into some of these markets, see what's going on in things that your competitors might have been doing. And that way you sort of have a little bit of option value to at least get the upside of a market you can't enter. Because if you did, you draw the ire of the authorities. And that would be another way to think about CVC.
That's really interesting.
Right? And you could look at across different institutional environments maybe and look for variation across that. But that could be another rationale under why to do it.
Yeah. If I had to do one of my big takeaways, I think it would be involvement. Like you need to be involved in these investments if you're going to learn from them, but with a light touch. So it's the big acquisitions, they're really not panning out for these folks. But having your R&D folks do the due diligence on these, maybe it's even some of the deals you didn't do, but they did the due diligence and they learn from that. It's keeping them up. So light touch involvement, but not too heavy-handed.
But Charlie, so I'm with you. But let's suppose we're consultants here. How do we operationalize light touch? I'm a big believer that structure matters, and I know you've studied organizational structure. So I would say, look, let's have a structure that makes sure that the big company bosses can't get too involved in it. Maybe they should have some window, but I'd like to set that up sort of in a formal structure, right? And that would mean keeping the CVC unit separate. I'd worry if it was left to discretion, because I think that light touch is going to turn into a heavy touch if we don't actually put limits on it.
That's true. There's across all areas of companies, so much evidence of that. This mission creep is an incredible thing.
I might take a gander at basically ways to replicate the incentives. So this is true in corporate entrepreneurship. One of the hot things now, we could do a whole other podcast on, is corporations trying to get more lean from the inside with these entrepreneurship projects, standing up businesses. DaVita Healthcare is a big one in this. What they did at DaVita, in some of their instances, is they set up kind of a parallel equity scheme where there was shadow equity in these entrepreneurial ventures to kind of replicate the risk-reward structure of a startup. Because in some sense, with these entrepreneurial ventures, these CVC units, you don't want the people from your company going in there as sort of a perk or a reward. You want people who are actually going to be taking this seriously, like a venture capitalist would, where their skin is in the game.
Yeah.
But if you get the wrong kind of people in this, you're not going to run the unit well. So that either means bringing someone from the outside, or maybe getting the incentives. And I'd think carefully about that if I was setting up a CVC unit.
Yeah, that's very interesting. That's very interesting. Well, so I'm also curious what you think. There's clearly some evidence across these different papers about what not to do.
Yeah.
So what did you think? I guess we've touched on a few of those things. Was there anything else that you would hit that the firm should stay away from?
Look, I think that if you're going to set up a corporate venture capital unit, I'm not so sure you should have someone from inside your company running it. I think you might want to source it from someone on the outside.
So like subcontract.
Because I think about this. Look at like big pension funds at the state level. They usually invest with an investment manager, a specialist. And so I think venture capital is a really tough business, evidenced by the returns. And what do VCs do, right? They pick deals, they win deals, right? And they add value, okay? So if you think somebody inside your company has those skills to do it, that might be good. But most often there'll be people who are already venture capitalists. The problem is adverse selection. What kind of VC wants to work at a CVC? But I would say that was one thing I thought was pretty interesting.
Yeah.
Also, I was wondering,
so I'd hit a few others. One, you mentioned kind of being distant from what you do, and I think there may be some sort of Goldilocks solution. You want to be different than where your company is, but not too different. But the interesting fact, and again, Gary just Dushnitsky, working with Miles Shaver, has really shown this. If you get too close to your home markets, there's many fewer deals. And it really appears to be, again, the best firms are avoiding you. There's that competitive overlap. They really start to worry. These investors really might mess with my game.
CVCs are usually going to syndicate with other venture capitalists anyway. So you have to think about, what kind of company is going to want money from this investment syndicate, right? Including VCs plus CVCs. But if having the CVC on the board could also be an advantage for potential acquisition opportunities. So it depends on the starter's perspective. A lot of people have written about that too. We're kind of taking it from the company perspective. I mean, look, I see all this as part of the broader push to get outside the corporation, right? Corporate venturing, open innovation. Companies are struggling to stay innovative and on the cutting edge. One way to do that is access outside knowledge, and CVC is one way to do that. I think it's one mechanism. There's lots of other things they could do that we can talk about in the future. I would say, though, being realistic about the goals is the other thing, and setting the whether the goalposts are financial or strategic on the outset could also be very useful. I also wonder why these things don't last longer. I'd be interested to see if people stick at it longer, whether they're more successful or if there's a way to think about that. Obviously, there's going to be bias in the data of the ones who stay around longer, but 4 years seem like really short on average.
Yeah,
for all
it's true.
CVC
It's
news to be
true.
around.
There are a few companies. I mean, Intel, Sony, they were on this in the 60s, and they've been at it since. But most companies seem to have one big freak out. Something's changing in their industry. They go in, they do it for a little bit just to try to grapple with that. But once it's resolved, they're
right.
back
I mean,
out
this
of
is
it.
what Song Mama, the finance PhD student at Duke, is all about. He's like, look, after they start when they're on an innovation downturn, they get into the CVCs to kind of help their innovation, and that works. And then they eventually abandon it, and that's the life cycle of corporate venture capital. But I wonder, less as a short-term strategy or a band-aid, if there's something longer-term that you could see these benefits. But that's kind of how I think about it too. So maybe,
I think you're totally right. It's just like part of the open innovation portfolio these companies have, but it needs to be a portfolio. So again. The evidence is you do better with it if you already do a lot of R&D.
That's right.
You do better with it if you have other ways of drawing in that outside knowledge.
Well, think about this. I mean, Charlie, this whole angle on absorptive capacity and open innovation as it relates is going to be really important in pharma going forward. So you see a lot of pharma companies essentially being hollowed out, right? The big things in pharma are now these conglomerates, right, that are acquiring all these different companies. And also you're seeing less R&D being done in the big pharma companies relatively. So how then are they going to be able to identify great acquisition targets and integrate that science if they're not doing their own internal R&D? So I think this is more than just like an academic point. This is going to matter for the bottom lines of pharmaceutical companies and also for the production of new innovative medicines. And so that's the thing to look at for folks who are studying this in the future. And the CVC investments might not pay off if you don't have the internal R&D to actually understand what you're investing in. So I guess that brings us to the end of our part on CVC, so the research chatter. We're watching the space going forward. I think it's going to be exciting in a lot of high-tech areas and around the world as well. And the scholars that we mentioned, you can find their papers on the website. Let's jump into our final segment, which we call I Wonder. This is where we propose one offbeat, funny, or just plain interesting idea that popped in our heads recently. All scholars have them, but as we've said before, we have a podcast, so you get to hear about them. Charlie, I'll let you go first as always. What are you wondering about?
All right. So what I'm wondering about is OODA loops. Have you heard of OODA loops?
I have no idea. I don't know if you're speaking English or Italian, but I'll just go with it. Okay.
Yep, it's neither. I think it's military acronym speak. But I want to, because we're both, I know, a little bit of political junkies. I want to give the setup. So where I heard about this was during the summer when Donald Trump was running kind of.
That's
circles.
Our next podcast, by the way. Can CEOs become good presidents? Donald Trump and Carly Fiorina would be a good one. Yep.
There we go. But it was the discussion when he was really clearly running circles around the rest of the field, and he would say something. You could just see the traditional PR machines kind of cranking and grinding and kind of propping screws and gears all over, and he'd be turned around and kind of poking fun at them again, and before they'd even manage to react once. And in the discussion about that on liberal blogs, first people using military analogies, and what came up was this sort of recent idea, not recent, so kind of 70s on idea from the U.S. military of OODA loops. There's a big military theorist, John Boyd, I think, who came up with this idea of the fact that military units that could react and turn more quickly to information in the field would have big competitive advantages. And
this sounds like dynamic capabilities to me, Charlie.
So, I think it relates to that. The OODA actually stands for observe, orient, decide, and act. So it's very focused on mental models. I had to look around once because I hadn't heard of it. I had to look around, and I actually found a really deep dive that's quite good on a website I'm almost embarrassed to mention. Sorry, but it's called theartofmanliness.com. But somebody did a really good piece on this. But so what I'm wondering about this is will this sort of idea connect in some way with research, and also military books for kind of executives kind of signal sort of concern with strategy and a certain manliness. Then you usually see Clausewitz on war and Sun Tzu on.
Well, this OODA loops could be next.
Yeah. So I wondered, is this going to show up on? Is this the next thing to show up on?
Look,
on
either that or
shelves?
it's the name for a great breakfast cereal. I mean, it sounds fantastic. But I think this whole idea of dynamic capabilities is very similar to OODA loops, and that might be what Trump has in terms of his ability to respond to people so effectively. Really interesting. And look, it wouldn't be the first time, as you said, that military strategy comes over into corporate strategy.
There is certainly a tradition of
and
borrowing.
Hey, in business and in politics, we love our acronyms. Speaking of that, someone mentioned to me that Trump, in terms of communication, he rarely says more than 5 words in his sentences. He uses very few words, very parsimonious. And one would argue in the age of Twitter and Instagram that parsimonious communication, even on TV, in those news shows, could have a big advantage. So something that maybe CEOs could be looking at in the future to mimic from Trump.
Maybe not something that academics have much competitive advantage
gosh,
with.
I don't know about that. It'll be interesting to see how that changes. So you've been wondering about something related to current events and Charlie Solvay. So the Volkswagen scandal stunned a lot of people in the business community, the political community, and observers. Long discussions with people about it. I've been wondering a lot about different dimensions of corporate social responsibility. I mean, there were many metrics under which Volkswagen was a very responsible company, and people really thought highly of it. But clearly there was this huge deception going on inside the company. And when we start to pick up the pieces, we say, what went wrong? What went wrong? Was it one bad apple? Well, it probably couldn't have, because these practices actually moved to other parts of the company, which is interesting, right? And so how does this actually happen? And could you actually sort of be ambidextrous when it comes to social responsibility? Maybe in other parts you're doing volunteer work, you're a responsible citizen, you're complying with regulations in the home market.
You know who I think that actually might describe a bit is British Petroleum, who had all those terrible problems in the U.S., but mostly through their acquired unit, and was actually pushing pretty hard at environmental stuff back home in the UK.
This is the point. I think that there's dimensions. So I put up this slide for my students where I show them, hey, here's a company that's won a bunch of safety awards in its industry. Here's a company that has, the highest percentage of minority women in its workforce. And I put up a chart. I said, this is Exxon, right? And I put up another company and I said, this one, the CEO has been sued for several times for harassment. They've had all sorts of issues around the company and scandals, but they do pay their workers, highly and only make things in the U.S., and that's American Apparel. And so what it shows people is that this CSR concept, or what it means to be a responsible company, is multidimensional, almost like companies have split personalities. And you can totally see how that would happen, where we would have a great volunteer program or a great philanthropy program, or be complying with regulations in one area, but be doing awful things on the other side under the same regime. And so I sort of feel like our CSR work has focused a lot on variation between firms, right, on corporate social responsibility. What about within firms? Some different units on different dimensions, and you might find some interesting stuff there. So that's what I've been wondering about.
That's interesting. I would love to see. I bet there is some research that speaks to that, but I'd love to see some more. That sounds cool.
I think with a lot of stuff, CVCs, this stuff, some qualitative work getting inside companies could get at this. There's some companies with enough business units, maybe you could do more field experiments, which is what I talked about today at SMS. Yeah. You could get that insight inside the company. But I think that's what I've been wondering about this time. And if someone's already doing this, send it to us, and maybe that'll be a future topic for Research Chatter.
Please do get in touch. Let me get to the next part. So that brings us to the end of our 3rd edition of Research Chatter. If you liked it and want to hear more, subscribe in iTunes. You can find it by searching for Research Chatter. And please spread the word. Our web home is now strategicmanagement.wordpress.com. That's a blog for the whole Strategic Management Society. But the only things posted there right now are our post about our podcast with links to the podcast. And there you can find list of the papers that we talk about this time. You can find our contact information, our Twitter addresses. So it's a good way to engage with us.
Hey, and don't forget to give us the feedback on Twitter. We're at @strategic_MGMT. Of course, you can also tweet out to Pontificate, Charlie's Twitter handle, and @Aaron Chatterji for me. Research Chatter is new. It's an experiment, and we're hoping you can tell us what you find most interesting and what you'd change. Thanks for listening. Signing off in Denver. I'll see you all at SMS.